If bad debt keeps showing up on CSEC exams and confusing you, this will help.
Welcome to this explainer. Today, we're setting the stage for a dramatic but highly practical journey into the world of uncollectible accounts. We're talking about the life cycle of a bad debt, how we anticipate it, how we write it off, and, the ultimate plot twist of actually recovering it. This isn't just theory to memorize for an exam. Understanding this stuff is absolutely crucial for managing real-world cash flow and making sure a business literally survives.
So, let's jump right in by anchoring ourselves in the Caribbean Secondary Education Certificate, or CSEC, arena. I'm talking directly to you accounting students out there, the diligent bookkeepers, and the small business owners joining us right now. The principles we're covering today are the absolute foundation of reliable financial reporting pulled straight from the official CSEC Principles of Accounts syllabus.
Here is our roadmap for today's explainer. First, decoding the CSEC syllabus. Second, planning for doubtful debts. Third, the bad debt write-off. And fourth, the surprise debt recovery.
Part 1. Decoding the CSEC syllabus. Let's look at the lay of the land so you know exactly what battlefield you're walking into.
You've got a split battlefield here. On one side, you have Paper 01, which requires you to navigate 60 rapid-fire multiple-choice questions in an hour and 30 minutes. Then on the other side, Paper 02 is where you really roll up your sleeves. We're talking 3 grueling hours to tackle 5 compulsory, deep problem-solving scenarios. You're going to need both speed and endurance to succeed here for sure.
Right in the syllabus framework, our topic lives in Section 6, Accounting Adjustments, specifically Objective 5, focusing on bad debts. And listen, this isn't just about kind of getting the theory. The syllabus demands that you master the specific journal entries and ledger account movements to actually write off these amounts.
Moving into Part 2, Planning for Doubtful Debts. This is where we see the warning signs and estimate our future losses. The big why behind everything we're doing today is the prudence concept. It's the accountant's golden rule. Prudence dictates that we play it safe. We absolutely have to record anticipated losses immediately so our business doesn't overstate its assets or pretend we have profits that, are never actually coming. We always prepare for the worst while hoping for the best.
Okay, let's put you in the hot seat. You're the accountant. Let's look at this high-difficulty exam question regarding M. Brown and translate this scenario into math. Brown wants to bump up his allowance from 8% to 10% on a $10,000 accounts receivable balance. He already has an old allowance sitting there of $800. So what entry do we need to make?
It's actually pretty simple when you break it down. 10% of our $10,000 in receivables gives us our new required target, an allowance of $1,000. But wait, we aren't starting from scratch. Our old allowance is already sitting at $800.
That leaves us with exactly a $200 difference to bridge the gap. We just need to top off our allowance bucket. Therefore, the correct entry is to debit the profit and loss account for $200, recording the expense, and credit the allowance for doubtful debts for $200. This increases our provision without actually touching the individual customer accounts just yet. Which brings us to Part 3, the bad debt write-off. We've safely anticipated the loss, but now an estimate becomes a harsh reality. Enter our tragic character for this scenario, J. Doe. On May 15th, J. Doe goes bankrupt. The writing is on the wall. We are forced to face the music and write off this specific, uncollectible $500 debt. It's no longer doubtful, folks. It's bad. To record this unfortunate reality, you've got to complete this double entry, perfectly mirroring a T account structure. You increase your expense by making a debit entry of $500 to the bad debts account. At the exact same time, you reduce your asset by making a credit entry of $500 to the accounts receivable account specifically for J. Doe. Now please, whatever you do, do not fall into this common exam trap. I see this all the time. People want to credit the cash account. Listen to me. You only credit cash if the customer actually paid you. In a write-off, no cash changed hands. You have to use the customer's specific name, J. Doe, in the accounts receivable credit to physically remove their debt from your sales ledger. Finally, Part 4, the surprise debt recovery. Just when you thought the money was gone forever, we reach the plot twist. When a previously written-off debt is suddenly paid out of nowhere, we witness a twofold financial miracle. Step 1. It's treated as other income, which directly boosts your reported net profit on the income statement. Step 2, because you actually receive the money this time, it boosts your liquid assets, your cash or bank balance on your balance sheet. The mechanics here are super interesting.
the effect on accounts receivable is entirely neutral in the end. Technically, the customer's account is briefly reinstated to show they owe it, but then, boom, it's immediately reduced back to zero the second the payment is recorded. The final tangible result for your business is a beautiful shift from a total loss into real liquid cash resources in your bank account. And that is exactly what keeps a business surviving and thriving.
We've seen how a debt can completely die and come back to life, totally transforming the numbers on a page. It really makes you wonder, if a written-off debt can suddenly return to boost your profits, what other hidden stories and sudden twists might your balance sheet be telling? Keep analyzing, keep questioning the numbers, and you'll find the story hidden within the ledger. Thanks for hanging out with me on this explainer.
As always, the link for this study tool is in the description below. Let me know what you think in the comments.